Did you know? Microsoft stock has risen about 25% this year, but among the magnificent seven tech giants, it's still trailing most peers, only slightly ahead of Amazon and Apple. What this suggests is that while the market is generally bullish on tech stocks, there could be a potential undervaluation in Microsoft. Today, I'm going to take you through a complete breakdown of Microsoft's growth drivers, potential risks, and how it's building a moat through Azure and enterprise services in the AI era, so you can better understand the relationship between short-term fluctuations and long-term value. Hey everyone, I'm Stock Market Breakdown. Microsoft's performance has been impressive, with its stock climbing steadily, but compared to giants like Google, Nvidia, and Meta, its gains are a bit lagging. Why is that? The main reason is that Microsoft's growth is heavily concentrated in Azure and AI services. These businesses have high margins, but are limited by capacity and delivery speed, which means short-term stock prices may not fully reflect their true potential. Azure has always been Microsoft's core growth engine. In 2025, Azure's cloud revenue hit $75 billion, up 34% year-over-year. And in Q1 2026, growth accelerated to 40%. The driver isn't just the broader digital transformation of businesses, it's also the rapid expansion of generative AI and large model deployments. Azure has built clear advantages in AI training and inference capabilities, and combined with Microsoft's Office and Dynamics ecosystem, it has strengthened enterprise customer retention, creating an almost irreplaceable service moat. However, there are concerns behind this growth. Microsoft's CFO has admitted that data center capacity is maxed out, and they can't fully meet customer demand in the short term. Capacity balancing, initially planned for December this year, has actually been delayed by 6 months. This means that even if market demand remains strong, Microsoft may not be able to fulfill all orders immediately. The logic here is straightforward. Short-term supply constraints may limit revenue growth, but in the long run, Microsoft is locking in customers through early AI and cloud investments. Statistics show that 62% of generative AI projects run on the Azure platform. This early deployment advantage helps create long-term customer stickiness, making it difficult for clients to switch to AWS or Google Cloud. Of course, potential risks still exist. If Microsoft can't expand data center capacity and network bandwidth quickly enough, customers may turn to Amazon AWS or Google Cloud, which could mean a short-term loss of some revenue. This also reminds investors that Microsoft's short-term stock fluctuations are driven more by supply limitations and competitive dynamics than by lack of demand. From a strategic perspective, CEO Satya Nadella, since taking over in 2014, has successfully transformed Microsoft from a traditional software licensing company into a leader in cloud computing, AI, and diversified technology. His strategy has shifted Microsoft's reliance away from Office and Windows revenues toward high-growth cloud services, while also positioning the company at the forefront of the AI era. In other words, Microsoft isn't just following trends, it's actively shaping the future of enterprise technology. This strategic transformation is what gives Microsoft multiple growth avenues beyond Azure. It's generating revenue through AI generative services, Dynamics enterprise software, LinkedIn for business networking, and GitHub developer tools. This diversified approach provides a defensive layer during short-term market volatility, while offering growth potential aligned with long-term tech trends. The market is also optimistic about Microsoft's future growth. Wall Street has 48 analysts, giving Microsoft a strong buy, with an average target price of $682, implying roughly 26% upside potential. This shows that institutional investors remain confident in Microsoft's growth engine, a long-term strategy, even if short-term stock performance is constrained by capacity bottlenecks. For long-term investors, this consensus is important. It indicates that even if the stock experiences short-term dips, institutions still believe in Microsoft's growth prospects and enterprise lock-in effects. In other words, any short-term declines or corrections are more temporary than a change in fundamental long-term value. Understanding this can help investors stay calm during volatility. In summary, Microsoft's opportunities are primarily concentrated in Azure and AI-driven enterprise technology markets. The risks come from data center capacity limits and competitive pressure. Investors who closely monitor capacity recovery, customer renewals, and AI project deployment speed can better navigate short-term stock swings while seeing the bigger picture for long-term growth. Azure isn't just the core revenue driver, is also key to locking in enterprise clients. As demand for generative AI and large models continues to expand, Azure's long-term customer stickiness could strengthen further, meaning Microsoft can maintain stable revenue streams and technical advantages even as competitors ramp up investment. If you're bullish on the long-term development of generative AI and enterprise cloud services, Microsoft's current valuation and potential opportunities are worth serious consideration. In the short term, capacity limits may delay some orders, but in the long term, this actually indicates massive market demand as Microsoft continues to expand data centers, increase computing power, and optimize AI services and enterprise software offerings. Revenue and profit growth could accelerate. Microsoft's strategic transformation and leadership are also key supports for its stock price and market position. Early investments in AI and cloud computing have not only increased revenue stickiness, but also reinforced long-term dependency from enterprise clients. Combined with LinkedIn, GitHub, and Dynamics, Microsoft has built a full enterprise services ecosystem, significantly raising switching costs for customers. This closed-loop ecosystem protects Microsoft's market share and provides a natural advantage for rolling out future products and services, keeping the company ahead of the competition. In the short term, the stock may be influenced by market sentiment, macroeconomics, or capacity limits, but from a mid to long-term perspective, Microsoft's accumulation of customer and technical advantages in the Azure and AI ecosystem is clear. This means that even if short-term fluctuations occur, the long-term value remains intact. All in all, although Microsoft stock has risen roughly 25% this year, it's likely lagging other tech giants, which may actually present strategic opportunities. The growth potential of Azure and AI, combined with the moat Microsoft is building in its enterprise services ecosystem, and the CFO's disclosed capacity expansion plans, all indicate solid long-term growth potential. Short-term opportunities and risks coexist, but the long-term trend is upward. Investors who track capacity rollout, customer retention, and AI project expansion can get a more complete picture of Microsoft's investment value. So the bottom line is this: Microsoft may face short-term capacity and competitive pressures, but the growth drivers in Azure, AI, and enterprise services remain strong. Monitoring capacity recovery, customer retention, and AI deployment progress will be key indicators for judging Microsoft's future stock trajectory. This is Stock Market Breakdown, and I'll see you next time.